Welcome to Section 2 of the PNJ Group Income Statement Training Series. This section takes you into the top of the income statement, how revenue is recognized and presented, how the cost of goods sold is built up, and what the gross profit line actually tells you about the health of a business. By the end of this section, you will be able to explain why gross margin is a leading signal of business health. Apply the ASC 606 five-step model, distinguish gross versus net revenue presentation, identify every component of COGS, and calculate and interpret gross profit margin. These are among the most practically important skills in income statement work. Here is why gross margin matters so much. It is the one place on the income statement where you can isolate the relationship between what a company charges and what it costs to deliver. No overhead, no financing, no taxes, just that core engine. When gross margin declines year over year without explanation, the handbook is direct about the possibilities. Inventory misstatement, inappropriate revenue deferral, unrecorded COGS, or a deteriorating competitive position. PNJ Group flags any unexplained gross margin variance exceeding 3 to 5 percentage points for investigation. Revenue on the income statement flows from a SC 606, the five-step model. First, identify the contract. Second, identify the distinct performance obligations within it. Third, determine the transaction price, including any variable consideration. Fourth, allocate that price to each performance obligation based on standalone selling prices. Fifth, recognize revenue when or as each obligation is satisfied. The income statement line you see is the output of all 5 steps applied simultaneously across every active customer contract. Getting any step wrong changes the revenue number. The surprising part of revenue presentation is how much it can change the top line without affecting net income at all. If an entity is a principal, it controls the good or service before transfer and presents revenue gross. If it is an agent, it arranges for another party to provide that good or service and presents only its net fee. Improper gross presentation overstates both revenues and COGS by exactly equal amounts. Gross versus net is one of the most frequent SEC comment letter topics. Always document your principal versus agent analysis and escalate uncertainty to the manager. Variable consideration is where revenue recognition gets careful. Amounts like discounts, rebates, refunds, and performance bonuses are only recognized to the extent it is probable that a significant reversal will not occur when the uncertainty is resolved. That is the constraint from a SC 600 61030-211. In practice, it means being conservative. If there is real uncertainty about whether a bonus will be earned or a return will happen, you do not recognize it yet. Estimated returns are presented as a reduction of revenue, not as an expense. Getting this wrong creates a future reversal problem. Watch out for this one. Revenue is recognized when a performance obligation is satisfied, not when the invoice goes out. If the right to receive payment depends on completing another obligation, you have a contract asset, not a receivable. A receivable only exists when the right to payment is unconditional, conditioned only on the passage of time. These two items must be presented separately on the balance sheet. The income statement impact is real. Revenue can hit the income statement before a receivable exists, and the audit team needs to ensure the underlying obligation was actually satisfied. COGS is not a single number. It is a buildup of 3 core layers plus adjustments. Direct materials are the components that go into finished products. Direct labor covers the wages of employees doing the actual production work. Manufacturing overhead absorbs factory costs, depreciation, utilities, supervisory labor, and quality control. Then come inventory adjustments. LCNRV write-downs under a SC 330 go into COGS, or are disclosed separately if material. and inbound freight costs are typically capitalized into inventory and expensed as COGS when the goods are sold. This is where things get interesting for service businesses. There is no inventory, so there is no COGS in the traditional sense. Instead, service companies use cost of services or cost of revenues to capture the direct costs of delivering services in the period. The concept is identical. Subtract those direct costs from fee revenue, and you have gross profit. Gross margin is just as meaningful a signal for a service company as for a manufacturer. The key difference is that service costs are expensed as the service is delivered, not capitalized and released through inventory. The gross profit calculation itself is straightforward. Revenue minus COGS gross profit margin is that result divided by revenue. What makes it powerful is what it isolates: the relationship between price and production cost, stripped of all overhead, financing, and tax effects. Year-over-year comparison is the test that matters. Most people focus on the absolute number, but the trend is where the signal lives. Under PNJ Group guidance, an unexplained decline of 3 to 5 percentage points triggers investigation and documentation. That threshold exists because variances at that scale rarely happen without a reason. The handbook is explicit about what a gross margin decline can signal. Inventory overstatement suppresses COGS and artificially inflates gross profit, so a significant jump in margin can be just as suspicious as a decline. Inappropriate revenue deferral shifts revenue out of the current period and compresses margin. Unrecorded COGS inflates gross profit temporarily. And of course, a genuine deterioration in competitive position through pricing pressure or rising input costs will compress margins as well. All of these require documentation. The 3 to 5 percentage point threshold is not a rule but a professional judgment trigger. Let us bring this section together. Gross margin is the first analytical signal on the income statement. It isolates what the business earns from its core activity before everything else. A SC 606 drives the revenue number through 5 steps. Whether that revenue is gross or net depends on whether the entity is a principal or an agent, and getting that wrong is one of the most common SEC common areas. COGS builds from materials, labor, overhead, and adjustments, and when gross margin moves unexpectedly, investigate it. Thank you for completing this section on revenue, COGS, and gross profit.